All right. For those of you on the East Coast, good afternoon. Those of you on the West Coast, good late morning. Thank you all for joining us. This is LARC's March 2026 U.S. Outlook presentation. If you don't know me, my name is Ryan Melliker. I am president and co-founder of Lodging Analytics Research and Consulting, or LARC for short. We're going to get started on the webinar in a second. Before we do, I just want to mention a couple things, housekeeping items that I think are really helpful for everybody. Number one is this webinar is being recorded. So if you have to pop off, don't worry. We will send the link to the recording out after the fact, hopefully later today, certainly no later than tomorrow. Number two is we will send the slide deck out to all of those that are in attendance here on the webinar. So you don't need to ask for it. I know somebody's going to ask for it, but just those of you that are paying attention now know that it is that you will get it. You don't need to ask for it. And the third thing that I just want to mention real quickly is that we are going to stay around for some Q&A after the end of the presentation. We usually have a bunch of questions. We'll do our best to answer everything. If we don't get to your question, my apologies. Feel free to reach out to us either at information@LARC Analytics, which is the easiest email to remember, or you can send me an email directly, ryan.melliker@larkanalytics.com. With that, we're going to go ahead and get started. We've got a bunch of things. We've got a lot to cover today. We're going to walk through real quickly kind of a backdrop of the industry in 2025. Then we're going to spend a lot of time on section 2 talking through kind of the economic outlook, all the different puts and takes that really drive our forecast for the hotel industry, which we'll discuss in 3 and 4. Then we'll dig into some market highlights. And then last but not least, we're going to discuss kind of an interesting dichotomy that we see out there between Dallas and Fort Worth, which people tend to think of, oh, it's part of the same metroplex, but we think there's very different dynamics unfolding there, especially over the next few years. So first of all, from a U.S. industry review perspective, the one thing that I really want to highlight that I think is really, really important is if you look at how performance migrated throughout the course of 2025, the first quarter was actually a decent quarter. We saw relatively decent performance in that, demand was positive, occupancy, ADR, and RevPAR were all positive. Things were encouraging. Some of that was helped by an Easter calendar shift, but nonetheless, there were still pretty good numbers. But things really turned really quickly starting in the second quarter. And some of that was the Easter shift. But I think the bigger factor there was really start of April of 2025 was Liberation Day. And we believe Liberation Day kind of, drove what we refer to as the tariff tantrum, in that there was a tremendous amount of uncertainty tied to what was happening with tariffs. Companies weren't sure how to react to them, what to do. The consumer got really worried, tied to a lot of the media attention on tariffs, what they're going to do to inflation and cost of living and all those types of things. So you saw a big, big pullback. Started in the second quarter, got much worse in the third quarter, and stayed pretty negative in the fourth quarter. So net, we saw RevPAR decline the second, third, and fourth quarters of 2025. Now, what's really interesting about that is that in those same 3 quarters, GDP increased 3.8%, 4.4%, and then even in the fourth quarter, it was up 1.4%, despite a 43-day government shutdown. So there was this dichotomy where RevPAR is really struggling, GDP performance seemed to be okay. And just going to put a pin in that because we're going to address it in a little bit, but I think it's just something to really keep in mind. Now, that's from a national perspective. You all know that hotels are operated at a market and really a street corner submarket, street corner basis. So if you look at things in a national benchmark, that can be helpful, but it's only so helpful. At the end of the day, there is a vast inconsistency in performance across the markets. These are the 62 markets that LARC issues quarterly forecasts for, so we track them very closely. And what you can see is we saw massive strength in markets like San Francisco, Palm Beach, St. Louis, where you saw RevPAR growth up, roughly 9% or more. And then you saw markets like Houston, Las Vegas, Savannah that were down close to 9%. That's a big swing, right? And understanding which markets are going to outperform can be really impactful in terms of trying to figure out, where to make investments, where to develop, all those types of things. So there are very different dynamics. Just using the national benchmark, I think, opens up a lot of holes, unless you're trying to build a national portfolio, which my guess is most people in here are not, but some probably are. Moving beyond the top line, I think what's important to highlight here is that with muted top line growth, you have declining EBITDA, where expenses were growing at a faster pace than revenues. And EBITDA dropped about 4% on our metrics. And values dropped close to 1%. Didn't drop a full 4% for two reasons. Number one, interest rates moderated a little bit, but number two is we don't value hotels on a single year's cash flows. Building out a discounted cash flow based on a forward outlook drives our valuations. So you don't see values fluctuate from, based on a single year's cash flows. Most hotel investors don't value hotels on single year cash flows. So you don't see those numbers almost ever move identical to one another. We saw a pullback, but nowhere near as big of a pullback as we saw in hotel EBITDA when it comes to hotel values. Now, shifting to our economic outlook and everything that's driving it, the first thing I want to say is, we're going to talk a lot about kind of what's driving the economy and the economic policies and fiscal policies by the current administration. Just because we think that a policy may be good or bad for the economy and the hotel industry in the short term, that doesn't mean it's a good or bad policy. There's lots of good policies for the country in the long term that have a negative implications in the short term on the economy and the hotel industry and vice versa. So don't take our view of a policy having negative implications in the near term as being a bad policy. That is not our intent. It is not our approach. Along those lines, I think, before we jump any further, we really have to address the elephant in the room, which is the Iran conflict. We released our forecast, the current forecast we're walking through, to clients on Friday before the Iran conflict broke out. That being said, for the past few weeks, the rumors and the concern about an Iran conflict have been gradually increasing. So some of that risk had been built into our numbers without a doubt. What we would generally say is that the conflict, first of all, just adds uncertainty into an already quite, cloudy outlook for the hotel industry across the U.S. Our assumptions are that the conflict does not persist for an extended period. However, if it does, it's likely to have materially negative consequences for the hotel industry, driven by three core factors. Number one, we'll likely see a spike in oil prices that holds up. If that spike holds up as we head into the summer leisure travel season, it will certainly impact gas prices, which will certainly weigh on an already stretched U.S. consumer, and their disposable income, and that will have a negative impact on leisure travel, especially in the summer. Number two is the stock market. Today, I think the stock market's down. The S&P 500 down about 1.5%. It's basically flat through the first 3 days of this week. We have not seen big movement there, but if this persists, it's very possible that we will, and that could create more challenges, especially for high-end leisure, which we'll talk about in a little bit. And then the third component is this dynamic that if the war in Iran persists for a longer time, for an extended period, and when I say extended period, I'm really referring to measuring in months, not days and weeks. We are looking at a situation where you're probably likely to see fewer foreigners coming to the U.S. for the World Cup this summer, and we're likely to see fewer U.S. citizens choosing to, take on air travel in the near term. Not necessarily because they are worried about Iran bombing the U.S. or anything like that, but let's just be honest. Iran is the largest state supporter of terrorism, and that translates into aircraft dynamics, which can add some fear. We could see hijackings, bombings of planes, etc. So there's some real concern surrounding travel that unfolds there, that I think will probably, if this persists, people may pause a little bit in making some of those choices. So those are just some of the kind of high level views of how the Iran conflict can impact our outlook. Again, we've got kind of a short-term conflict built into our numbers, but the long term is a much different story. Like I said, if this is measured in months, it becomes a much bigger issue for the hotel industry. Now, remember I'd mentioned before, hey, GDP was actually good in 2025, especially the last three quarters of 2025, while RevPAR growth was really bad. And does that make any sense? Well, if you go back historically, there's always been a really strong relationship between GDP and RevPAR, right? From 2000 to 2019, if you looked at annual GDP growth and compared it to RevPAR growth, you saw an 81% correlation and a 66% R squared. Very, very strong. Now, if you go from 2020 to 2025 and look at it on a quarterly basis, quarterly because we don't have as many years and as many data points, so we expand the data points, you see that really break down where the correlation is 12% and an R squared of 1.5, so virtually no relationship. So we have seen this bifurcation between broader economic growth and RevPAR growth during and following the pandemic. And that's important to highlight because it means you can't really just focus on GDP to say, hey, if GDP is good, the hotel industry is going to do fine. That world is no longer around. So the big question is why? Why has the relationship broken down? And we think it's really driven by, two to three factors. Number one is we saw a big mix shift coming out of the pandemic, where we now have much more leisure transient demand than we had before, and much less corporate transient demand than we had before. So as a result, the drivers of economic growth matter a little bit more. The drivers that drive leisure transient are now having an outsized impact on RevPAR growth, and the drivers that drive corporate transient demand have less impact on RevPAR growth. And then we're going to dig into how those drivers as well are a little bit different in and of themselves from where they were pre-pandemic. And then the third factor that I think is really interesting, we're going to discuss in a little bit as well, is this international demand shift, where we've seen a pretty substantial shift in foreign travel demand in terms of foreigners coming to the U.S. and U.S. citizens going abroad versus pre-pandemic. But more on that in a few minutes. So let's start with kind of those macro factors that drive corporate transient demand. So, like I said, business investment has historically had a really strong relationship, driving RevPAR overall, really few focused on corporate transient demand. Almost an 87% correlation, 75% R squared. Corporate profits, not quite as strong, but still really good, 78% correlation, 61% R squared. And when you think about those forecasts going forward, and these are forecasts from Moody's Analytics, when you think of through 2026 and 2027, what we'll highlight is when it comes to business investment, numbers actually look okay. They're decelerating as we go through the year, but they're still pretty strong, 4% in the first, 4% in the first and second quarter, 3%, 2%, et cetera. Decent numbers. The challenge is that business investment is heavily driven by AI investment. And it's about companies choosing to build AI, build data centers, some of those unique components. If you back out expected investment in AI, we're basically looking at flat business investment in 2026 and 2027. So now the question becomes, well, does AI investment have the same impact on hotel demand and corporate transient demand as traditional business investment does? Well, traditional business investment is historically, investing in software and travel and building new products, hiring new people, all those types of things that can translate into more heads, B, bringing in consultants and advisors and bankers and whatnot. And those things don't necessarily translate into AI investment, where it's not about consulting, it's about doing things in-house and doing things more efficiently so you don't need as many people. And that translates into a reduction in corporate transient demand, not an increase in corporate transient demand. So we don't have a ton of empirical data to point to, hey, AI is pulling back on corporate transient demand, but there's a lot of risk that could probably happen over the next few years. And more importantly, it seems if you understand what that investment is today and compare it to what business investment has been historically, what you can see very clearly is that those types of things aren't going to drive the same level of corporate transient demand as historical business investment has. And then from a corporate profits perspective, profits had been declining throughout most of 2025. They're expected to decline in the first quarter, but then we start to turn positive as we move through 2026. Excuse me. And if you think about that positivity, a lot of that is tied to not so much revenue growth, but cost-cutting initiatives. And cost cutting isn't always a good thing for hotels, right? If companies are spending less to preserve their to increase profitability, whether that be through hiring or travel or any other means, it translates into less corporate transient demand, not more. So we have this dynamic where, hey, what's driven corporate profits and business investment historically to have those strong relationships is very different than what's projected to drive them going forward. And that can translate into some softness related to corporate transient demand. The other thing that I really think is important to talk about is the job market. So, the reality of, Liberation Day and Trump's tariffs, which unfortunately have not really gotten a lot better right now in terms of the uncertainty, is that they just sowed a lot of doubt. CEOs and company executives didn't really know how much things were ultimately going to cost them and didn't know how the tariff could change from 1 week to the next or 1 month to the next. And then when you had the Supreme Court here, the Supreme Court trial, be announced, it started to be like, okay, well, maybe we should wait for a resolution to that. And then the hearing happens in November, and people feel like, oh, it seems like they're moving against Trump's tariffs. Maybe I just need to wait. And then the Supreme Court finally comes down and, deems the tariffs, not all of them, but most of them, illegal. And then Trump's response is, we're just going to do a 15% tariff across the board, but that's only good for 150 days. And now you have pushback from foreign entities that already, struck trade deals, all these types of things. There's just a lot of uncertainty surrounding all of this still, and that lack of, that lack of clarity and understanding the rules of the game that you're playing within makes it really hard to make strategic decisions. So what we've seen over the past 6 months, the 6 months ended January, is excluding the healthcare sector, which is not economically sensitive. We've actually seen the U.S. shed 135,000 jobs. In fact, only 3 of 13 sectors have experienced positive job growth over the last 6 months. Healthcare, leisure and hospitality, and other services. The reality is, whenever we've seen this many sectors experience negative job growth for an extended period of time, historically, we've been in a recession or heading into one with 0 false positives. Yet stock markets at or around all-time highs. Only 27% of economists surveyed by the Wall Street Journal anticipate the U.S. will enter a recession over the next 12 months. So how is this all balanced out? Well, I think the answer is relatively simple. We are seeing a lot of shifting, increased productivity tied to AI, the idea that a lot of the job stagnation is relatively, self-induced, that, if we have clarity surrounding the tariffs, we can have the job market can start to shift again. It's nothing structural with the economy. It's much more driven by, these policies. So I think that gives a lot of economists hope that things can stabilize and that we can move forward once we get to that point. The hope is that we get there sooner than later. In terms of the stock market, we had, despite all the noise from, despite all the noise from the tariffs and the uncertainty and lack of hiring, and even corporate profits declining in 2025, we actually saw the stock market increase 16%. So there was a lot of strength. There was certainly some noise, don't get me wrong. We saw a big correction around Liberation Day, but then things rallied. And I think just put a pin in that, because I think the idea that we're at all-time highs is really, really telling, because it really kind of impacts that wealth effect that I'm going to talk about in a little bit. And then shifting from, the corporate side to the leisure side, we've seen retail sales tread water throughout 2025. Could have been worse, could have been better. We didn't see meaningful acceleration, but didn't see things terrible outside of kind of the, April, May timeframe immediately after Liberation Day. There's still some softness, but it's not an issue that's super concerning. However, when you look at consumer sentiment, we see something very different, where consumer sentiment in May of 2025 reached a 45-year low, lowest level since 1980 of 53.6. Now, things bounced back over the summer, which was encouraging, but that consumer sentiment index certainly weighed on summer leisure travel season. Then it bounced back a little bit, and then during the government shutdown in the fourth quarter, it fell again, and by December, we reached a new low. So how do you marry a consumer sentiment that's declining like this with retail sales that are treading water? The answer is relatively simple. For those of you that read the Wall Street Journal or pay attention to economists, you've probably heard the term K-shaped economy. What a K-shaped economy is that there's a bifurcation between the haves and the have-nots. And right now, the haves are winning and the have-nots are losing. What this chart shows is basically the top 20% of US households by income generation, how much they're making, now account for about 60% of all consumer spending across the US. That is the highest level on record. Meanwhile, the bottom 80% account for about 40% of all spending, which is the lowest on record. We are seeing that high-end consumer performing particularly well. Stock markets are at all-time highs. They feel pretty good about the wealth effect. They have the assets, their balance sheets look really good, and they're willing to spend. Meanwhile, the low end is struggling in terms of living. 29% of Americans are living paycheck to paycheck, largest on record. About 7% of Americans of subprime auto loans are delinquent. That's the highest on record. We talked about how soft the job market is, which creates concern for the ability to find alternatives and grow your wages through making moves. And as a result, you have limited wage growth. All of these things come together and you see this bifurcation, which is a real challenge. Not so much a challenge if you own and operate luxury hotels, because catering to these guys is a good place to be as long as that stays up here. But we just entered a war. Like I said, stock market's down 1.5% today. 1.5% is not a lot. But if we see a massive correction, what you end up seeing here will likely see a bit of a change. And that can be concerning for that high end. So again, the longer this war persists, the worse things will ultimately become for the hotel industry. Now, I told you to stick a pin in that international travel remark that I mentioned earlier, and here we are. So here's what's kind of interesting about foreign travel, right? In 2019, the US was a net importer of foreign travelers to the tune of about 4 million more foreigners came to the US than US citizens going abroad, right? And inbound and outbound foreign travel has been really strong post-pandemic, right? We saw decent strength. The US recovered really quickly coming out of the pandemic. The dollar was strong, which made foreign destinations affordable for US citizens, and US citizens really traveled abroad. By 2025, there were 25% more US citizen trips going abroad than there were in 2019. It was a pretty big number, right? And it was still up in 2% in 2024, despite the dollar falling. Now, if you think about foreigners coming to the US, it was a little slower to recover initially, but it started to gain momentum in 2024 when things were up about 10%. But then in 2025, we did a full reversal where foreign inbound arrivals dropped 12% or dropped 4%, and we're now 12% below 2019 levels, right? So to give you some perspective, first of all, why did that happen? Well, I think a big part of that was the rhetoric coming out of Washington, D.C. As I like to say, President Trump has made a career out of negotiation, and he starts really aggressively and hostile, and then may pull back thereafter. But what you end up seeing time and time again is, as he goes aggressive and comes out hot, as I like to say, he alienates people and can tick people off. He said Canada should be the 51st state in the country. What happened? The Canadians said, well, I don't like that. He's disrespecting us. Screw it. We're not going to the US this year. We're going to go to Mexico and the Caribbean. Whether they continue to go to Mexico with the cartel wars is a different story. But those are the types of things that we think are really, really important, that kind of highlight some of the challenges that we saw in 2025. And if you put all that together, what it basically says is, hey, in 2025, there were 18 million more foreign travelers or US citizens going abroad than there were foreign travelers coming to the US. Compare that to the 4 million more foreign travelers going to the US than going abroad. It's a gap of 22 million people, right? 22 million trips. If you figure 4 nights a stay for foreign travel, that comes out to 90 million room nights, or just about 90 million room nights, right? That's about 4 percentage points of occupancy nationally. Obviously, that's skewed to gateway cities, but it gives you the sense of what we're looking at. So from that perspective, I think it is really, really important. And then when you think about all of the different dynamics that, can impact individual cities tied to this, the first thing that we'll tell you is, not every city gets impacted the same, right? You see markets like Miami, New York, Honolulu, San Francisco having much higher exposure to inbound foreign arrivals than markets like Pittsburgh, Cincinnati, New Orleans, Nashville, et cetera. And also, it's not just about the exposure, it's also about the pace of recovery. So markets like Dallas, Seattle, and DC are back to pre-pandemic levels of inbound foreign arrivals, while Honolulu is still 43% below pre-pandemic levels. So again, the pace is very different across different cities. You can look at the national metrics and give you some points nationally, but looking at your individual market can tell a very different story, which is why we always say focus on your market, less about the nation. The nation gives you a good overview storyline, but things can vary meaningfully from there. Now, shifting gears, I want to talk a little bit more about kind of some of the factors that drive our corporate transient outlook. First of all is return to office. For those of you that have tuned into our webinars before, this slide should be relatively familiar. Every quarter, we post a slide like this that basically shows, hey, here are some big headlines pointing to return to office acceleration, right? I can point to these headlines every quarter for the last 5 years. Unfortunately, it doesn't show up in the numbers. Office utilization data from Castle Systems, which you see here, and I don't want to say Castle's the end-all be-all on this data, but the rate of change is really helpful. Has basically been relatively stable, slightly above 50% for over 2 years now. We're not seeing any meaningful movement. The second thing is that return to office, from a flex index perspective, another data source, basically points to things having stabilized over the past, call it, year or so, up at around 2.87 days per week in the office. So we're not seeing an acceleration despite all the headlines. This is nothing new. Shouldn't be anything surprising. This is the new normal we're living in, where people are in the office fewer days per week than they were pre-pandemic, plain and simple. And then what's really important about this is, the sectors or the industries that have the most flexibility in terms of being in the office are also the ones that generate the most hotel demand: technology, insurance, professional services, financial services, et cetera. So why do we care about this? Well, if people are in the office fewer days per week, those salespeople, those client relationship managers that want to go see them are less likely to spend as much time visiting because they're not in the office, right? So if you go back to 2023, the major airlines, Delta, United, American, et cetera, all basically said, hey, we're back to pre-pandemic levels for our corporate clients. But hotels still haven't gotten there. Why not? Well, with fewer days in the office per week, the salesperson that's going to fly to Los Angeles for a bunch of sales meetings, they're not going to be able to get as many meetings in because people aren't in the office as much, and they're not going to go meet with them in their kitchen. And that translates into, instead of what would have been a three-night stay is now a 2-night stay. What would have been a 2-night stay is now a 1-night stay. And what was a 1-night stay is now an out and back same day. So we've seen a substantial reduction in corporate transient length of stay. And that data plays out. Go check out your Calibri data and you'll see that, point very, 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 very clearly. And I think it's really, really concerning, if you ask me. And it just points to one of the challenges we're seeing from a corporate transient perspective. Good news. Group is strong, right? Group was the winner in 2025. We expect Group to be the winner in 2026. For those of you that don't know, we track the 30 largest convention centers across the U.S. We get their data directly, and we incorporate it into our forecast models for each of those cities, as well as across the U.S. overall. And what you see here basically is that in 2025, convention room nights on the books increased 4% year over year. Definite room nights were up 4% for convention centers. In 2026, they're up 8% year over year. We are pacing very, very strong numbers. 2027 is then flat to 2026. So that's really encouraging from a group perspective. It's really encouraging from a pricing power perspective as we move through 2026, where you've got kind of a greater base level of demand from those conventioneers, enabling shrinking your hotels, enabling being more aggressive on a pricing perspective for transient travelers. But it's not the same across all markets. Strongest markets, Philadelphia, you've got A, the World Cup, B, All-Star Game this summer, and C, the 250th anniversary celebration in the United States in Philadelphia, LA, World Cup, as well as a strong convention calendar in general. And then Orlando is also really strong. Weakest markets shouldn't surprise anybody here. Those markets tend to be tied to convention centers that are under renovation right now. Dallas, Austin, and Houston are all under renovation, and that's impacting their numbers. Now, when we look at the kind of macro factors that drive our outlook from a GDP growth perspective. Again, I told you GDP is not the end all be all, but the numbers here point to an acceleration in GDP growth in 2026, which sounds good in theory, but job growth is expected to be, virtually non-existent. Unemployment rate ticking up ever so slightly on a year-over-year basis. Corporate profits will be positive, but they don't turn positive until the middle of the year. And again, we talked about some of the challenges to why they're turning positive, maybe not being so encouraging. And then on the flip side, you have CPI accelerating, which is not encouraging from a consumer perspective. The hope here is that maybe with the higher inflation levels, hotels will try to push their rate a little bit more aggressively, like we saw in past periods when we had elevated inflation. And then you also have the dollar falling. The dollar falling is a good thing in that it creates, the dollar falling creates, it makes the U.S. more affordable for foreign travelers, and foreign destinations more expensive for U.S. travelers, and that should continue to hold. But consumer confidence is projected to turn more positive in the middle of the year, which would be good as well. So those are some of the factors that kind of drive our outlook. And then when you think about some of the assumptions in our outlook, our view is the Fed's going to cut rates 3 times in 2026, March, June, and July. Then it will stabilize. The Fed funds are stabilized right around 3%. Tariff rates are stabilizing around 12% is the baseline assumption. The Iran conflict, as I mentioned before, will be brief, measured in days and weeks and not months. And that's really important. The other one that's really important that we'll talk about in a minute is the partial government shutdown gets resolved by the end of March, and no near-term U.S. recession, though economic growth will be muted. So with that backdrop, there are, as we think about our near-term outlook for the hotel industry, there are a lot of puts and takes, positives and challenges. To focus on the positive, comparisons will begin to ease in the second quarter. That's encouraging. The World Cup, which we're going to get into a lot more detail in a little bit, should be a tailwind for the industry. However, the longer the Iran conflict persists, the less of a tailwind that will be, plain and simple, and that is a concern. The SALT tax relief from the big beautiful bill under the Trump administration will provide some tailwinds for the consumer balance sheet that will likely show up in the second quarter of 2026 in advance of a stronger summer leisure travel season. The high-end leisure traveler will continue to be strong, supported by that robust stock market and increasing wealth levels that I just mentioned. If we see a big stock market correction, which could happen tied to the rising price of oil, that would be very, very negative, not just for high-end leisure travel, but the broader economy, as that high-end consumer is really propping things up right now. Talked about group demand and convention bookings already. Another thing that I would highlight is that, look, 2025 was fraught with a ton of headwinds and uncertainty surrounding the Trump administration's policies. Now, I'm not saying those headwinds go away, but if they just stay what they are, they're no longer headwinds. They now become neutral on a year-over-year growth basis. And that actually isn't that's not as bad, right? I'm not saying it's going to be good. Just hey, looking for some of those silver linings. That's something to highlight. Now, on the flip side, there are challenges, right? A lengthy conflict in Iran will negatively impact travel demand. It's going to reduce foreign arrivals. It's going to reduce disposable income levels across the U.S. And it's going to raise fears around travel safety. Those are concerns, and we can't be naive to them. Limited job growth and traditional business investment is going to limit leisure transient demand and business travel demand. Um, Uncertainty on tariffs following the Supreme Court ruling and then Trump's subsequent response, which we don't know what's going to happen after 150 days, could further cloud these issues and keep that uncertainty in play, which doesn't help things. And while the World Cup should be a tailwind for the industry, in 2026, the longer the Iran conflict persists, the less positive that's going to become. And if the Iran conflict, continues into late April, even and into May, there's real risk that it will have a far more muted impact than we're certainly hoping for. And then along the same lines, for those of you that don't know, the federal government still can't figure out how to, work together. And we're in the middle of a partial government shutdown, where TSA employees are not getting paid. It's only a matter of time until they start to call out, until you start to see the federal government try to impose reductions in travel like they were looking to do back in November because they don't have the staffing levels and they can't support it. We would expect this to happen more quickly than it happened in November, and that creates added concerns. So this is a real concern if this doesn't get resolved. And unfortunately, I don't know that it's going to anytime soon. It doesn't seem like the two sides are anywhere close to an agreement one way or another. So there are new challenges that we're dealing with in 2026 that frankly we weren't in 2025. So those are a lot of the puts and takes that really drive our outlook for the U.S. hotel industry. Now, when we think about the three different demand segments, corporate transient in general, which is the dark blue column here, we expect a pullback in 2026. That's tied to that lack of job growth, the lack of traditional business investment, some of those challenges that we talked about before. We ultimately think that it will stabilize around 10% below pre-pandemic levels. Group, on the flip side, we think that's the strongest segment in 2026. That's that light blue column here where we see a modest uptick in 2026. That full 8% that we're seeing in convention bookings isn't going to materialize across the entire group segment. As we move through the year, we expect to see some attrition, coupled with smaller groups may not be performing quite as well. But nonetheless, group is still one of the big winners coming out of the pandemic. We're looking at group stabilizing roughly 5% above pre-pandemic levels. And then you have leisure. And leisure, on the flip side, came out of the pandemic gangbusters. You had all that revenge travel after the pandemic, and it's been gradually moderating ever since. In 2026, we expect an ever so slight moderation, but that's because we see benefits from the World Cup. If we don't see those benefits from the World Cup, that leisure reduction will pull back more meaningfully. Nonetheless, we generally think leisure stabilizes around 10% above pre-pandemic levels. So losing segment coming out of the pandemic, corporate transient, winning segments, leisure, followed by group. Supply is a great silver lining for the hotel industry if you are an existing owner operator. Not so great if you're a brand or somebody trying to grow. There is muted supply growth, plain and simple. The long run average supply growth across the US is about 1.8%. This year, we're forecasting 0.6%. Next year, 0.6%. And then a 5-year CAGR of 0.8%. So we're talking about a third of the historical level. That is really muted supply growth. That's good. There are some markets that are higher. St. Petersburg is number one in our list, but keep in mind that's really fueled by reopenings following the hurricanes. So it's not necessarily new inventory as much as just inventory coming back online, impacting those numbers. Then when you look at, and then Phoenix, Puerto Rico, Savannah, Memphis, all higher. But all of those numbers, while you see kind of high relative to 0.8%, still not astronomically high. We've seen markets in the mid single digits over the years for a 5-year CAGR, and we're nowhere near that. So generally speaking, our view on supply is relatively benign. And then we certainly see markets that have virtually no supply coming Um, Now, for those of you that don't know, if you ever purchase one of our reports, you'll see the back testing of our forecast model. We build models out specific to each market. This is our RevPAR model for the US overall. The dark blue line is the actuals as reported by CoStar on a seasonally adjusted basis. Light blue line is the model that we've built, estimate that RevPAR historically, and then based on Moody's forecast for these factors, going forward. It has a 98.8% R squared, highly accurate. You can look at that model and see how accurate those two lines are to one another. And that drives our outlook for RevPAR going forward. Same thing for ADR. You see right here, again, 98.9% R squared. Variables are a little bit different, highly accurate. And when you put it all together, our outlook for 2026, moderated ever so slightly. This quarter, we dropped from 1.2% RevPAR growth quarter ago to 0.6, but ADR went up and occupancy went down. I think generally speaking, most of the forecasters are within the same ballpark except for HBS, which seems to be the optimistic one. I think we'd all probably love to see them being right, but I'm not holding my breath on that right now. And then the other thing that I'll highlight is we are by far the most conservative on occupancy and by far the most aggressive on ADR. That is not new. That is something that we tend to generally be year in and year out. And that's okay. I think that's proven generally more accurate, and we'll walk through that in a second. As we look to 2027, we continue to see occupancy decline, ADR to increase, but RevPAR is going to be roughly flat. So we are the most conservative in terms of RevPAR growth in 2027. What I will tell you is that if the World Cup impact is more muted than we expect in our baseline scenario today, and ADR growth is not that 3% in 2026, and it comes in much closer to where some of the other guys are, it's not going to impact the absolute rev ADR for 2027. Now, that 167.46 doesn't necessarily change. It just means that the growth moves from 26 to 27 because that's tied to the World Cup, which we know is a one-time blip and is not in this number right here. So just something to keep in mind that the World Cup being softer just will increase the growth in 2027 if that plays out. Now, from a quarterly perspective, we expect RevPAR growth to effectively turn positive in the second quarter. That's driven by the things I mentioned before, the World Cup impact, SALT tax reductions, and soft comparisons. However, if the conflict in Iran lasts longer than our baseline scenario, or the partial government shutdown lasts longer than our baseline scenario, we are looking at that recovery being pushed out further. Could be third quarter, could be fourth quarter. We'll see. Depends on how long those issues persist. And then, as you will see in 2027, 2Q is actually negative, and that's tied to that World Cup comparison that we're seeing there. On a price class perspective or chain scale perspective, our general view is the higher end segments will outperform. The light blue columns here are 2026, where you can see upper upscale really benefiting from that group pace that we're looking at. Meanwhile, the economy segment is going to continue to struggle, largely fueled by that that K-shaped economic recovery, and the lower tier of the U.S. consumer really having a hard time. And then from a market location perspective, we think the winners are going to be urban and interstate. A lot of that's tied to the World Cup. Followed while the losers, we think airport will be really soft. Again, that's tied to partial government shutdown and the Iran conflict, which we think has an outsized impact on that segment going forward. When you think about the World Cup, I'm not going to spend a ton of time on this. Those of you that have tuned in our webinars in the past have seen these slides, and they are unchanged. This World Cup is unprecedented. It's not just in scale, but also in geography, right? 16 cities, 3 countries, longest distance ever between host cities. It creates a lot of cross-city travel cost and logistical complexity for fans. There's extended time gaps in between matches. And what that basically means is if the match is in a host city that you don't really want to hang out in for an extended period of time, you're probably not going there. Or you're not going there for long because there's not matches on back-to-back days. Even if it's not your team, there aren't any matches on back-to-back days. There's no doubt there are some geopolitical and consumer sentiment headwinds. We talked about kind of the sentiment towards the US from foreigners. That certainly plays a role. But let's take a look at Russia in 2018. And believe me, there was negative sentiment towards Russia in 2018 after Russia annexed Crimea from the Ukraine, shortly before that. We think this is a reasonable comparison. And if you think about Russia back then, you know, what's kind of interesting is the World Cup alone lifted national RevPAR for the year by about 7 percentage points. Massive number. Now that was heavily skewed to Moscow. Moscow was the gateway city, it's hosting the finals, and it was the media hub. All three of those things. In June and July, RevPAR growth in Moscow of 2018 were up 200% year over year. Massive, massive growth. You say, well, yeah, but how strong was that relative to prior? Well, May and August were flat. So that's the type of pop that the World Cup can generate. And it can generate that type of, I'm not saying the same level because Moscow has fewer hotel rooms than New York and a lot of other cities in the US, but meaningful growth. We generally think that, you're going to see real tailwinds from the World Cup tied to those gateway cities that are strong international tourism destinations and are hosting great matches. So that's New York, that's LA, Miami, Atlanta, Dallas. It's less so the Kansas Cities, the Bostons, the Philadelphias of the world. And then if you look at kind of the match schedule, we've gone through and listed the match schedule by city and highlighted, where there's kind of a team that historically has had a strong fan base that will follow them. And what you will see, if you're a fan of Spain, you can go to Atlanta and see Spain on the 15th, but you don't see the Spain again until 6 days later. So if you don't want to hang out in Atlanta and do some of the things there, that's very limited for you. Same thing in Boston. If you want to see England, guess what? You don't get to stick around in Boston and see England again. You got to go to an entirely different city. They're in Dallas, they're in Boston, they're somewhere else. These are the challenges that you're seeing from a fan base perspective. So it has to be a city that you want to play. You want to spend time in. I mean, no disrespect to Kansas City. Kansas City's got some great barbecue, and I'm sure I'd have a blast there for a couple of days. I don't think I want to stick around for 5 days to see multiple matches, especially if it's not my team. So I'm not confident that you're going to see good lift from Kansas City. San Francisco doesn't have any marquee match, teams playing. So again, I think all of this points to some of the limitations that I think that you're going to see across various different cities, with those five that I highlighted before being the ones that are likely to benefit the most. Not that there won't be some marginal lift for these other cities. I think there will be. It just isn't going to be nearly as large. And then the falling dollar, again, should be a tailwind here, where falling dollar makes it more affordable for foreigners to come to the US and more expensive for US citizens to travel abroad. Now, because we have all this uncertainty and we don't really know how long the Iran conflict is going to last, we don't know how long the partial government shutdown is going to last. We don't really know what's going to happen with all these tariffs and the implications that they're going to have. We have upside and downside scenarios to our forecast. And generally speaking, the easy way to think about the upside scenario is that, hey, the economy is going to massively outperform our baseline, right? We're going to see strength across business sentiment, consumer confidence. Employment is going to improve. You're going to see financial markets that are stable. The conflicts in Ukraine and Iran are resolved faster than expected. Same with the partial government shutdown. Political and economic tensions between the U.S. and China diminish, and then we can be looking at really strong RevPAR growth this year. To me, that's an unlikely scenario, but it's possible. And then there's the flip side, which is the downside scenario. Again, this is a situation where the economy is going to underperform materially from where our baseline expectation is. The effective tariff rate rises, the conflicts in Iran and Ukraine and the partial government shutdown persist longer than expected. Risks grow that China blocks the Taiwan Strait, takes advantage of kind of the US's focus on Iran. The declines in European economies and retaliatory tariffs hurt U.S. exports. Corporate earnings falls, as a result. Unemployment ticks up, peaks in the middle of 2027. Rising unemployment rate causes housing prices to drop. Stock market falters. We enter a recession. The wealth effect, dissolves really, really quickly, and you no longer have the high-end leisure travelers supporting hotel performance. And that translates into close to -8% RevPAR growth this year. Again, I don't think it's a likely scenario, but we're trying to provide kind of those bands of where things could be, based on the different scenarios that could ultimately play out based on the Moody's outlooks for various economic situations. Now, one thing I'll highlight when you think about our forecasts, and I think it's always important, our approach to data is we're firm believers in better data in equals better data out, aka garbage in equals garbage out. As you guys look at data and you're trying to formulate your plans for the future, using the best data, I think, is really important. I encourage you to do that. We certainly do that with our data. And in a lot of cases, that doesn't come from us. But what I find really interesting is when others don't use the best data available. Seems like I usually make the argument decisions based on bad data are almost always bad decisions. Knowing how good your data is matters. You might as well make a decision based on no data as opposed to bad data, which is usually worse. So our historical operating data that drives our forecast models comes from STR or CoStar. We take that historical and we build our own models using Moody's Analytics as our economic forecaster. We're the only forecaster that incorporates convention pacing data into their numbers. We think that really matters. I'm not sure how you can forecast for pretty much any major market, certainly markets like Chicago or New Orleans or San Diego without knowing that data. We use Moody's for office market data. Supply, we do a lot of work on ourselves, but we also work with a couple of different supply pipeline vendors. Short-term rental data comes from AirDNA. Historical cap rates come from CoStar, and transactions in our analyses come from our partners at LW Hospitality Advisors. And as a result of that approach, it's really translated into, frankly, better forecasting. Nationally, we've been the most accurate for the last 5 years. In 2025, we missed occupancy by 10 basis points. So we talked about us being usually the most conservative on occupancy. It's proven now to be relatively accurate, generally speaking. 2025, we were also more optimistic on ADR than really played out. PwC had a better ADR forecast than we did. But we felt pretty good about our results in 2025. 2024, we were by far the most accurate for RevPAR growth, coming in 60 basis points off. Nobody else was than 1 percentage point. 21 and 22, we were the most accurate for occupancy, ADR, and RevPAR. And in 2023, we were not the most accurate. We give PwC the blue ribbon there, but only us and PwC were within 1% of occupancy, ADR, and RevPAR growth. So when you put it all together, nationally, our forecast accuracy kind of has proven to be among the best. And then at the market level, if you go back to 2021, take a look 1 year out across our 62 markets, whether you're looking at 21 for 22, 22 for 23, 3 for 24, or 4 for 25, we are more accurate in 70% of our markets, 80% of the major markets. 2 years out, we're more accurate. 3 years out, we're more accurate. And that really, really matters. And that's why we always say, the data that you're using really matters in terms of driving your results. So moving beyond the top line, let's talk about labor costs real quickly. Labor is a real concern. Union is a major, major issue that we're seeing this year. We've got the New York union contract coming up for renewal at the end of June. Great timing, given the World Cup will be in the city. I'm willing to bet a high degree of confidence we're going to see a labor strike in June. That's not going to be great. Unite, we also have Chicago later this year, and Unite here National is trying to coordinate New York and Chicago with other cities that are coming up for renewal in 2028 to try to have a national renewal in advance of the Summer Olympics. That would obviously not be good for the hotel industry in general. I'm not sure it's going to happen or not, but it's certainly a risk. But even without that, you're seeing wage growth in that 40 to 50% range over a 5-year contract for most unions. And what I think is really important about this is the headwind won't be associated with only union hotels. At the end of the day, the big challenge with union hotels is that work rules and work restrictions, right? The lack of flexibility. So if you're our non-union hotel in a union market and the union pays this wage, you pay this wage to try to stay non-union. So when the union wages go up, what do? You go up too. So that translates into increased wages across the market. A lot of the major, what I refer to as the big blue cities, have a lot of concerns surrounding this. So it makes me really, really nervous regarding expense growth. Then you have the political risks. Again, big blue cities. We've seen minimum wage hikes in across California. New York had the Safe Hotels Act. Chicago, thank God it didn't move forward, but there was a budget plan by the mayor to incorporate tax on companies that brought their employees to the office. Yes, brought your employees to the office, you were going to get charged a tax. Crazy, but certainly played out. Didn't move forward, but these are massive risks to performance across a lot of these markets, and something to be mindful of. Overall, we expect wages to increase at about a 3% compound annual growth rate over the next 5 years. Property taxes at about a 5%. Overall expense growth will be slightly positive in 2026 and 2027. Keep in mind that's on an absolute basis. We have occupancy declining, so you're actually seeing POR is going up at a much higher level than that. So just keep that in mind. And then from an EBITDA growth perspective, we've got muted EBITDA growth, slightly positive in 2026. Again, if the World Cup doesn't deliver the way we expect, that will turn negative. And then 2027 is negative, tied to those World Cup comps that we see there, before we see kind of some modest growth in 28, 29, and 2030. Here's our cap rate model, just like I showed you with our ADR and RevPAR. Dark blue line is the actuals, light blue line is our model, 98% R squared. Now, when you put it all together, you can see our forecast here through 2027 that basically just shows effectively pretty muted growth right now. With EBITDA growth slightly positive in 2026, but then slightly negative in 2027 before, as I mentioned before, we'll see some positivity thereafter. And that's driving some increase in property values, which we expect to be up 1% this year and 3% in 2027. 3% from this year, from 2025 in 2027. So another 2% in 2027. Now let's talk about markets. I know we're running out of time here. These are the 62 markets that we issue our quarterly forecast on. Of those 62 markets, RevPAR growth here, you can see there are winners and there are losers. Maui stands out as a big gainer. Why is Maui so much better than everybody else? There's two factors here. One, Maui is recovering from the wildfires. Two, for those of you that are not aware, late last year, Maui added a new restriction eliminating 7,000 short-term rentals from Maui. Short-term rentals are now illegal. West Maui, they're all illegal this year. The rest of Maui will be phased out over the next couple of years. That reduces inventory for competitive inventory across Maui, as those units need to be used for long-term housing in a pretty meaningful way. That's going to be a nice tailwind for that market over the next few years. Philadelphia, I showed you the convention calendar. New York, World Cup benefits. Fort Worth is a really interesting market with a lot of good things, and I'll talk about that in a little bit. We'll see Dayton, soft comparisons. You get the idea there. On the bottom end, St. Louis and Ann Arbor, really difficult comparisons. Ann Arbor also has a lot of supply growth this year. St. Petersburg, supply growth with those units coming back online. And then you also see Atlanta with a soft convention calendar. Pittsburgh, difficult comps. Again, those are some of the reasons why we like some of those markets more than others. We look at a 5-year outlook. Top performers, I talked about Maui already. We will also see a lot of strength in Palm Beach. Palm Beach is going through a massive transformation, and it's not all about Trump and Mar-a-Lago. Turning into Wall Street South with massive financial services expansion to a market that 5-10 years ago did not have corporate transient demand. We're now seeing it in a really big way. Orlando, you have the new Universal Park that will create a lot of demand for that market. Convention calendar is fantastic. And on top of that, at some point, we're going to see foreign inbound arrivals return to that market and perform really well. On the other end, DC is a really soft market tied to government demand. Dallas, we talked about the convention calendar. We're going to talk a little bit more about that in a little bit. Louisville, Louisville has a sluggish economic growth. Pittsburgh, soft economic growth and difficult comps. San Francisco, 2025 was a banner convention calendar year. We're seeing a pullback thereafter outside of the Super Bowl this year. So that kind of frames that. The one thing that I want to highlight real quickly here, which I think is interesting, is you'll see Fort Worth here in our top 10 and Dallas here in our bottom 2 over the next 5 years. We're going to talk about that in a minute. Now, when you think about things from a 5-year value perspective, our favorite markets, Orlando, New Orleans, Tampa. I talked a little about Orlando already. New Orleans, strong convention calendar, modest expense growth. And we think the convention entertainment district in New Orleans is going to transform that city very, very positively. Tampa, you've got great economic growth, a robust convention calendar, especially in the out years, and a really attractive value proposition relative to South Florida. That's going to lead to strong top line growth in a muted expense growth environment. Really, really encouraging. One of the things that you notice, all five of those cities in our top five are low expense growth environments. That's really, really important. On the bottom end, Dallas, we're going to talk about that in a little bit. We're pretty cautious there. Soft convention calendar is a primary driver, but not the only driver. Elevated expense growth, New York and Chicago, difficult comps in St. Louis, declining government demand in DC, frame some of those outlooks. Now, let's talk about Dallas versus Fort Worth, because we think this is a really interesting dynamic. So why are we so bullish on Fort Worth? Fort Worth just completed a $95 million convention center renovation. They are embarking on phase two of a convention center renovation, which is really the expansion. Except the nice thing about it is it's not the convention center. It's an adjacent arena. They have an outdated arena that they are demolishing and rebuilding as 150,000 square feet of additional function space, ballrooms, meeting rooms, and exhibit hall. 150,000 square feet of incremental space that's scheduled to open in 2028. That is really, really attractive. And in the meantime, you've got a brand new, shiny, renovated convention center that is not being impacted by the construction. Number two, special events in Arlington, aka the World Cup in Arlington. I don't know how many people knew this. Arlington is technically in the Fort Worth market, not the Dallas market. Um, you know, and that is the world, not only World Cup host, but also the media hub host in Arlington. That's really, really positive, and I'll explain in a minute why that's more positive for Fort Worth than Dallas. Then strong corporate relocations. We've had a bunch of companies move into Fort Worth. There's a list of a handful of them over the past year or so. Then you have lower supply risk in Fort Worth. They have only 2.2% of existing inventory is under construction. And we forecast a 1.4% 5-year CAGR for supply growth. So that's above the national average, but certainly not high. Compare that to our Dallas story. The convention center story is incredibly challenging. They are redeveloping it. Convention booking pace is down 30% this year. No year through 2029 is pacing within 35% of 2019 levels. And importantly, when you embark on a project as big as Dallas's project, over $1 billion public infrastructure project, it's a ton of risk that there will be delays. Whether there are delays or not, event managers are certainly going to take a wait and see approach to make sure things are actually going to open before they start booking that convention center over the next few years. So this is probably much more of a 2032 story than a 2029 story going forward. Special events in Arlington, as I mentioned, Arlington is technically part of Fort Worth, not Dallas. Also, the Dallas market has 2 times the hotel inventory. Fort Worth actually over 2 times, which means that if they each got the same amount of demand from Arlington, which again, Arlington is in Fort Worth, you will actually see a better impact on Fort Worth than you will on Dallas. And then, so we don't think the World Cup will have the same impact on Dallas as it will Fort Worth. It's going to be better there. And then corporate relocations. Here's what's kind of interesting. You see a ton of headlines about all the companies relocating to Dallas, and that's great. And there are, but they're not relocating to downtown Dallas. In fact, downtown Dallas is seeing a mass exodus. In January, AT&T was the latest to announce plans. They're the largest employer in the CBD, and they're picking up and moving their corporate headquarters out to Plano. In fact, Bank of America, Deloitte, Wells Fargo, Caterpillar have all relocated into suburbs outside of downtown Dallas over the past year or two. This is a big, big issue because downtown Dallas is where the vast majority of the hotel rooms across the market are. It's by far the biggest CBD. It does not generate a lot of leisure demand. And with the convention center in the knife, it's not generating a lot of group demand either. So if you have the submarket with the most rooms, with reducing corporate transient demand, minimal leisure demand, and minimal group demand, you're going to see a big sucking sound in terms of pricing power across this market over the next few years, which is going to be really, really hard. And then from a supply growth perspective, Dallas ranks 12th out of our markets, 3.3% of existing inventory under construction. So it's obviously considerably more than what we're seeing in Fort Worth. Not only is 3.3% 50% higher than the 2.2% Fort Worth, but again, it's a lot more rooms because Dallas already has more rooms, so 3% 3.3% is off of a higher base. And the CAGR is a 1.8% CAGR versus Fort Worth's 1.4. And then for those of you that have not seen our LARC GIS application, I really encourage you to reach out and check it out. This is a heat map of RevPAR growth across the Dallas-Fort Worth market or Metroplex. And what you can see, darker is stronger. You see a scale of RevPAR growth right here over the next 5 years. And you can see where RevPAR growth is poised to be strongest versus where it's poised to be weakest. It is heavily skewed to Fort Worth and away from Dallas, which is really, really interesting. Now, what I will tell you is that there is a lot of demand growth in North Dallas. The challenge is there's also a lot of supply growth in North Dallas, Plano, Richardson, Frisco areas, all the way up to Denton. And that's what limits the growth that we're seeing, not to mention the sucking sound of all the lack of demand downtown that will ultimately impact everything. So with that, before we turn it over to Q&A, and Katie's going to answer some questions, and I apologize for going a couple minutes over. I just want to highlight to everybody, at LARC, we offer 3 different service lines. Number 1 is our quarterly market intelligence reports, where we issue these on 62 cities every quarter. You can purchase those on our website, larcanalytics.com/shop. They are available for purchase at any point in time. You can also subscribe to them. Then we have our LARC GIS application, which is a web-based application that enables you to walk through, really dig in to a given hotel location, extract a RevPAR forecast for the area around any hotel, any development site you're looking for, even get a location quotient or a LARC score for any hotel or development site you're looking at. Really, really transforming how developers are underwriting locations, how lenders are underwriting deals, et cetera, and investors are thinking about things. And then we do a lot of advisory services, whether that's in the form of bespoke market reports or investment strategy support or market strategy support, you name it. With that, I'm going to stop and take questions. If you're curious about anything, don't hesitate to reach out to us. And like I said, you can purchase our reports at larcanalytics.com/shop. Katie, how's our Q&A?
We actually have quite a few, so I'm going to jump into it. Between the
Great.
impacts of COVID and the AI revolution on corporate business travel, the business travelers have changed their behavior. When do you think the major lodging brands will face the realities that the largest and most profitable segment is declining?
That's a great, great question. I mean, I think there's no doubt that it's declining and it's changing in a meaningful way. I think that they'll come to that realization when their brands stop getting used and developed, right? At the end of the day, the largest brands are brands in and of themselves. They don't really care, if you're going to develop a Courtyard by Marriott, they're going to, okay, do it, right? We'll take our franchise fee. We don't care. So it comes from the ownership community to push back saying, hey, you guys your positioning is wrong and it all has to shift more towards leisure. But it comes from them not generating the revenue because of the owners and developers shifting away.
With a completely unpredictable message from Washington, how does a long-term investor balance actions to then pivot to economic decisions?
Oh, it's a great, great question. I think that our approach to that is you can only make decisions based on what you know at a given point in time, understanding that information changes. There's always uncertainty coming out of Washington and uncertainty in economic outlooks and things like that. None of this is anything new. The level of it just may be a little heightened. I would simply say that, you make decisions based on what you know to be true and what you have high conviction in, and using the best available information at that point in time to make that decision. Understanding, hey, that information changes over time, and we can only be as good as we are at that point in time.
Does the group pace reflect the FIFA blocks that have recently been dropped?
The group pace takes into this group pace data is as of end of January 2026. So anything that was dropped prior to end of January 2026 is incorporated. Anything after that was not.
With the change in the correlation of GDP to RevPAR, did you change your model?
We tweak our models every quarter. We're constantly, as we get more data, we're tweaking our models and adjusting them. making sure that we're using the most relevant factors based on the most relevant information at that point in time. So yes, the models change.
Have you done back testing related to your out-year supply models?
Very much so. To give you an idea, we've gone back in time and taken a look at what percentage of planning projects actually open within a 5 and 10 year period, looking at over 20 years worth of data on that. And every market's a little bit different, but generally speaking, across the country, we've seen 20 to 25% of projects in planning actually open within 5 years. It's a pretty small number. Which is why in our GIS application, we don't even include any projects in planning because we don't know which ones will actually open. We focus solely on under construction there. In our market forecast, we do build out a percentage of planning projects that actually open. We also take into account historical conversions out of hotel supply.
On the demand side, how much is dampened by short-term rentals?
You know, uh, Minimal in short. So we track data, we use data from AirDNA, and we take a look at historical revenues. And the way we think about short-term rentals, and I'll give you probably a long-winded answer to this, but hopefully it'll be helpful, is we look at this single unit, like whole unit, studio, 1, 2 bedroom units as competitive with hotels. Somebody renting a 5 or 10 bedroom house is not comparing that to a hotel. That's just not the consumer that a hotel is catering to. So if you think about that, hotel comparable unit, and you look at the revenue, the revenue across the U.S. according to AirDNA for that business is in 2025 was 4.8% of broader hotel industry revenue. 4.8%. Okay. It is not a huge number. Is it growing? It absolutely is growing. And it's something to be mindful of. We think the impact is less on demand and more on pricing power because that inventory flexes when pricing gets higher, when there are citywides and sellouts and things like that. It has a much bigger impact. We would also tell you that every market is different. Short-term rentals cater much more toward leisure travel and much less towards corporate transient travel. So understanding those dynamics is important. And then the regulatory environment. In New York City, for example, short-term rentals are illegal in Manhattan. Um, so again, all of those factors come into play too. Understanding those nuances is really important. All of that detail is in our market reports.
Your economy forecast came down a lot since your last forecast. What changed recently to drive such a large negative revision?
The economy forecasts come from Moody's Analytics. We're not the economists. We just plug their economic forecasts into our numbers. And I don't think they've come down a lot for 26 and 27 relative to where they were a quarter or two ago. Frankly, they're not too far off. Things have been relatively muted for quite some time. Um, what I would say is I think that the tariff uncertainty is a big factor. The lack of job growth that we're continuing to see is also playing a role in a really muted economic outlook.
Could you see limited travel for the World Cup, thus a bust in the benefit, and therefore what is the downstream flow? You're being far too optimistic given geopolitical matters.
Yeah, I think we're going to see. As I talked about before, I think we used Russia as a baseline. I don't think the geopolitical matters that we're seeing today in the US are materially different than what we saw in Russia in 2018. That being said, I do think especially the Iran conflict, if the Iran conflict persists into April or even May, it will certainly reduce our numbers. There is no doubt about it. It has to. If the Iran conflict does not, and it's resolved, like I said, in a matter of days or weeks, as opposed to months, it's a different story where we think there will be ample time for the bookings to materialize and everything to be okay. But I don't know how long this conflict is going to last.
It's been published downtown San Antonio is having unprecedented new demand, development, redevelopment, plus 6 billion in total. The Alamo, Project Marvel, Hemisphere Park, historically average performance. Is downtown San Antonio now one of Texas's best investment submarkets?
Well, in short, I'd say no. But let's go back to our outlook. San Antonio's right here. So it's not it certainly falls within, our top 10. But it's not a market that we're screaming at loving it. The thing to remember about San Antonio is the economy in San Antonio is very government related. There's not a lot of traditional corporate transient demand. It's kind of low end leisure and government and group. So a lot of those big projects that you just talked about aren't necessarily going to translate into a substantial amount of demand for hotels. And this is one of those dynamics that continues to unfold when you look at kind of taking a multifamily approach where you see, oh, look at the household income boom and the, population growth in San Antonio is a home run, but it doesn't translate into hotel performance. And that's kind of the big difference in San Antonio versus some other markets because of the composition of the economy and the composition of the hotel demand there. So by no means are we negative on San Antonio. We're just not super bullish. When we think about Texas, we'd much rather be in Fort Worth, which we talked about before.
Considering that the large uptrend in the Fed funds rate in the middle/late Biden administration significantly eroded supply and new development in lodging and CRE in general, how large of an impact does cost of capital have on your supply forecast?
It has an impact, but I think the other thing, I mean, look, at the end of the day, the supply forecast is not as driven by cost of capital. We're taking a 5-year view, so it's really easy to see what's under construction today. And that gives us a good visibility over the next 2 to 3 years. And then we generally see what's in planning and taking a look at in planning. We know that only 20 to 25% of that has historically materialized. And then how many units typically, churn out because they're outdated or converting to something else. That plays a role. And then to a lesser extent, we'll look at kind of cost of capital, but not just cost of capital, also construction costs. As construction costs go up, it also plays a role. So while we have said that, hey, 20 to 25% of planning projects typically open in, within a 5-year period, we'd say today it's probably closer to 15%.
Under the state of the world, how much more favorable do you view heavy active military markets like Norfolk, San Diego, Fayetteville?
Not super heavy. Um, and there's, I think trying to make a play on a market like that based on, a conflict in Iran today, I think is very short-sighted because these are long-term investments, which makes it really hard. If you believe that you're going to see massive growth in the defense sectors in those markets, not just over the next 12 months, but over the next 5 years, that's a different story. Um, we rely on, like I said, the Moody's Analytics economic forecasts to drive our views on those markets, and that is not their baseline assumption.
Per CoStar, Tempe, and Phoenix had surprisingly the highest year-over-year RevPAR growth for all of the Phoenix submarkets for the upper upscale and luxury sector. What do you think is driving this?
Um, I'd have to get back to you on that one. I have not done a lot of digging into Tempe specifically. Sorry.
Any reaction to the Citrini research report on AI and the potential for a doomsday scenario?
It's a scenario. My reaction is that it's 100% a scenario. I think the reality is nobody knows what's going to happen with AI and how it's going to evolve one way or another. Um, our view is that we think AI is going to increase productivity in a very, very, very meaningful way, but it doesn't happen overnight. It takes time. And it also translates into increased productivity, translates into, I don't want to say a loss of jobs, but jobs change and businesses evolve and they're different. And that has to happen. As technology advances, those types of things have to shift. When I was in graduate school, our marketing professor, used the example of, one of the most successful companies in the early 1900s in the U.S. was a company that made boogie whips, whips for the horses. Well, car came out and technology changed, and nobody needed a boogie whip anymore, and the company went away, right? At the end of the day, if that company had evolved to making steering wheels, or understanding how things shifted, then you can, leveraging that technology in a new way, you can be successful. The reality is businesses will change, they will evolve. There will be a lot of disruption tied to AI. I think most of it's probably for the good, but some of it will be for the bad. And it's about focusing on how to leverage the changes as opposed to trying to ignore them.
With the flight of premium corporate demand flushing out of downtown Dallas, does the massive luxury new supply pipeline, especially centered in Uptown, have defensibility?
I think the luxury is defensive in that it's the segment that, is performing well, especially the high-end leisure. And Uptown is probably the one area of the downtown submarket that has some decent leisure demand. Um, but I think that the overall CBD is going to be challenged. So there's some defensiveness there, but it's certainly not. Um, I think that if you're losing a lot of corporate demand and you don't have the base level of group demand across the market, your pricing power is going to be really, really limited, and it makes it really hard. So yes, it will probably hold up better than other hotels in the in the submarket, but not necessarily hold up well.
What is the outlook for the Washington, D.C. market, considering the downturn in 2025 related to the Doge cuts and similar factors?
Yeah, I mean, I think as hopefully you saw with some of the slides, we're pretty negative on DC from a value perspective and pretty negative from a RevPAR growth perspective going forward. The Doge cuts are a component of that, but we just don't see government demand in downtown returning anywhere near what it used to be. And there's just too much supply for that. We think that, there are pockets that will perform fine. If you're not, if you're in a submarket by the convention center, and the arena and whatnot, where you've got the Wizards and the Capitals and the convention center driving the vast majority of your demand, you're going to do fine. But if you're in a submarket closer to Capitol Hill, it's a different story, and I think there's a lot of challenges.
Can you talk a little bit more about the San Francisco outlook? Do you expect other segments outside group convention pace to recover over the next few years?
I think we're going to continue to see growth, but I'm not sure that I would call it recovery. I think that the reality is across San Francisco, it was funny. I was in San Francisco for ULI in November, and it was AI this, AI that, AI that, AI everything. This city's back, everything's booming. The reality is we're seeing a ton of tech layoffs, a tremendous number of tech layoffs tied to this dynamic of, well, we don't need the same number of people. Software as a service is now facing a tremendous amount of uncertainty and questions and pressure. And that's huge companies in the tech industry out of the Bay Area. There are puts and takes to all of this. And our view on San Francisco is it's a market where top line will be okay. It bounced back really, really strong in 2025, which was great, fueled by a convention pace that was like 70% above where it was a year earlier. This year's up 9%, but if you back out the Super Bowl, it's down. And the following couple of years are down as well. So you're seeing a pullback in convention bookings. I think you're going to see some tailwinds from corporate transient tied to some recovery, but some headwinds tied to AI and layoffs and reduction in staffing and all those types of things that mitigate some of that I think create some challenges. Some of the leisure will do a little bit better because I think you're going to see a wealth effect there that will be positive. Um, so it's a balancing act of all those three things. But the reality is what makes us cautious about San Francisco, which again, we're not negative on San Francisco, just not super positive, is the expense dynamic. That's an expensive, cost of doing business in San Francisco is very, very high. And if you don't have really strong revenue growth, it does not translate into EBITDA and value. And that's what keeps us muted.
What is the sustained RevPAR growth following a World Cup or other major event like the Olympics, Super Bowl? Does demand go straight back to what it was in the year prior to the event, or is there sustained increased demand thereafter?
So it's a great question. And I think the answer becomes it depends. And it depends on, are you showcasing a city to part of the travel population that is unfamiliar with that city. And if that's the case, then it can potentially create kind of a longer term tailwind for that city. For New York, that's not going to be the case, right? LA, that's not going to be the case, right? So I think when you think about it it's about understanding that perspective. And the reality is the World Cup is going to be a handful of, small events, right? And I think that you're not going to see a tremendous amount of long-term demand based on 5 or 6 football matches across the span of 3 or 4 weeks in most of these cities, where frankly, most travelers, especially foreign travelers not familiar with those cities, are going to go. And the cities they are more familiar with, they already know them. So I don't think it creates that same level. So I'm not as optimistic that you're going to see this kind of big long-term tailwind from it. I don't want to say that you can't. It's just less likely. I think that, Atlanta for the Summer Olympics, I think that was back in 2000, that was kind of new and different. Hey, Atlanta's on the global stage. Atlanta's never been on the global stage before. It opened the doors for a lot of things. That's not LA in 2028. It's not Atlanta today. So I think those differences are really important.
Thoughts on Tampa/St. Pete? Nearing the end of the year-over-year monthly top-line declines we have seen since Q3, Q4 last year, flat the rest of 2026.
Look, I mean, I think you see the data here in terms of where we are. St. Pete, we think faces a little bit of headwinds, but a lot of that's tied to the inventory coming back online following the hurricanes. Tampa, we're a little bit more positive for, but not a lot. You see them right here again. Inventory coming back online is having an impact. But if you take a longer term view, we're much more positive, right? Just to give you an idea, if you find those two cities, taking on a much longer term view, you're going to see much better numbers. Tampa shows up right here. As we move forward, plus you have, like I mentioned, a strong convention calendar. Looking out a little bit further, St. Petersburg's also much better than towards the bottom of our path. For some reason, I can't find. Here it is, right here. So again, we think there's some headwinds in the near term. But long term, great prospects.
Don't see NYC in the 5-year RevPAR CAGR. What is the expected 5-year RevPAR CAGR given it is one of the top markets for 2026?
Yeah, so the New York is right here in the 5-year RevPAR CAGR. It's towards the bottom. We have a pretty cautious view of New York over the longer term. We think 2026 is benefiting from the World Cup, but that's a blip and not sustainable.
What is driving the growth in Raleigh, North Carolina? Is it corporate related or something else? Will this market be a strong contender in the next 5 years in RevPAR?
Yeah, I mean, we love Raleigh. You see it right here. We talk about it quite a bit. So it's a market that has a great base of demand driven by um, the government seat coupled with 3 universities in the area. Great corporate demand, especially in the Research Triangle from tech, and you have a convention center expansion with great group and good convention calendar. Those 3 things combined lead to really strong numbers for us. The economic growth is through the roof, job growth, expansion, everything looks really good. It's also a low cost environment, which is really attractive from an EBITDA and value perspective as well. It's a market we really like.
And right now, this next question is the last question. How is the union situation in New York, which is real and upon us this summer, factored into your view of New York City as an investment location?
Very much. We talk about it, right? New York is right down here from an investment perspective. We are really worried about wage growth and expense growth in general in New York, and the union situation is one component of it. I mentioned earlier with the union contract up for renewal at the end of June, right during the World Cup period. We expect a strike this year, which will obviously be negative. And we are very worried about a 40 to 50% um, incremental wage hike over the next 5 years.
And that's still the last question.
All right. Well, thank you all for sticking around. I appreciate it. If you have any other questions, want to dig into us, learn more about our offerings, what we do, don't hesitate to reach out. If you want to purchase any of our market reports, You can buy them on our website really easily, or reach out to us if you want to subscribe to any. We can make that happen as well. Much cheaper when you subscribe versus buying them one-off, FYI. But thank you for the time. And like we said, we will send out the slide deck and have the recording posted on our website shortly. Thanks so much, and hope you all have a great day.